PepsiCo just delivered a quarter that looked better than expected. Revenue beat Wall Street estimates. Core earnings also came in ahead of consensus. Under normal circumstances, that should have been enough to send the stock higher. Instead, investors sold the stock. So what did the market see that wasn't obvious from the headline numbers? Is this simply a short-term overreaction, or is Wall Street becoming more concerned about Pepsi's long-term growth story? In this video, we'll go beyond the earnings report to understand what is really driving investor sentiment. We'll examine slowing demand in North America, changing consumer behavior, pressure on margins, the company's competitive strengths, and the key catalysts that could shape Pepsi's future. Let's dive in. On the surface, Pepsi delivered exactly what investors wanted. Revenue came in above expectations. Core earnings also beat analyst estimates. Management even maintained its full-year guidance, suggesting confidence in the business despite a challenging environment. Yet none of that was enough to satisfy the market. The stock fell as investors looked beyond the headline numbers and focused on something much more important: the future. The question is no longer whether Pepsi had a good quarter. The real question is whether its growth story is beginning to change. If this were just one disappointing quarter, Wall Street probably wouldn't have reacted so strongly. But investors are beginning to see a broader pattern. Pepsi's largest market, North America, is no longer growing the way it once did. After years of driving revenue through higher prices, the company is now facing slower volume growth as consumers become more selective with their spending. For a business built on consistent and predictable growth, even a modest slowdown can change how investors value its future. And that is exactly why the market is paying such close attention. The biggest challenge facing Pepsi isn't another beverage company, it's a different consumer. After years of inflation, shoppers have become far more price-conscious. They're buying fewer impulse items, switching to private label alternatives, and paying closer attention to value than brand loyalty. This shift matters because Pepsi's success has long depended on the strength of its iconic brands. But when consumers begin changing their habits, even the strongest brands must adapt. The question now is whether this is simply a temporary response to economic pressure, or the beginning of a lasting change in consumer behavior. For decades, Pepsi has been able to do something very few companies can: raise prices without losing many customers. That pricing power has been one of its greatest competitive advantages, helping drive steady revenue growth even during periods of higher costs. But today's environment is different. Consumers are becoming more selective, and higher prices are no longer being accepted as easily as before. As volume growth slows, investors are beginning to ask a critical question: is Pepsi's pricing power weakening, or is this simply a temporary adjustment after several years of aggressive price increases? Slowing demand is only half of the story. Pepsi is also navigating higher costs for ingredients, packaging, transportation, and labor. While the company has built one of the most efficient supply chains in the consumer staples industry, cost inflation continues to put pressure on margins. This creates a difficult balancing act. Raise prices too much, and demand may weaken further. Absorb the higher costs, and profitability comes under pressure. It's a challenge that every consumer goods company faces, but for Pepsi, the stakes are higher because investors have come to expect consistent and resilient earnings year after year. While investors are focused on slowing growth in North America, Pepsi's business is far more diversified than many people realize. Nearly 40% of its revenue now comes from international markets, where many regions continue to deliver healthy growth. At the same time, Pepsi isn't just a soft drink company. Its portfolio spans snacks, sports drinks, energy beverages, bottled water, and nutrition products across more than 200 countries and territories. Short-term challenges are real, but they don't tell the entire story. The real question is whether these headwinds are weakening Pepsi's business, or simply masking the strength of a company that has adapted to change for decades. Pepsi's competitive advantage goes far beyond brands like Pepsi, Gatorade, or Lay's. Its real moat is an integrated distribution network built over decades. Every day, the company delivers beverages and snacks to millions of retailers through one of the largest direct store delivery systems in the world. That scale creates a powerful advantage. Retailers prefer reliable suppliers with broad product portfolios, while new competitors would need enormous time, capital, and relationships to build a comparable network. In other words, Pepsi isn't just selling products, it has built an ecosystem that is incredibly difficult to replicate. Great companies don't survive for decades by standing still, they survive by adapting. Pepsi has done it before, expanding far beyond carbonated soft drinks into snacks, sports drinks, energy beverages, and healthier product categories. Today, the company is investing in zero-sugar drinks, functional beverages, high-protein snacks, and digital capabilities across its supply chain. The challenge isn't whether Pepsi recognizes the changing market, it does. The real question is whether these investments can grow fast enough to offset slower demand in its traditional business. That may be the single most important question investors need to answer today. Despite the market's concerns, Pepsi continues to generate the kind of financial performance most companies would envy. The business remains highly profitable, consistently produces billions of dollars in free cash flow, and has a long track record of returning capital through dividends and share repurchases. More importantly, Pepsi has demonstrated resilience across multiple economic cycles. While growth may fluctuate from year to year, its ability to generate cash has remained remarkably consistent. That financial strength gives the company the flexibility to invest in innovation, expand internationally, and navigate short-term challenges without compromising its long-term strategy. After examining Pepsi's challenges and long-term strengths, the next question is simple: how much of this uncertainty is already reflected in the stock price? Based on my valuation framework, I estimate a conservative value of $127, a historical fair value of $160, and an optimistic value of $205. With a fair value of around $160 per share, the market appears to be pricing in slower growth, but not a permanent decline in the business. Of course, valuation is never a prediction. It is simply a framework for understanding expectations. The lower the market's expectations, the more important it becomes to determine whether those concerns are temporary, or whether they signal a lasting change in Pepsi's business. Wall Street may be right to worry about slowing growth, weaker consumer spending, and pressure on margins. Those risks are real, and investors shouldn't ignore them. But markets can also become too focused on short-term headwinds. Pepsi has spent decades building global brands, an unmatched distribution network, and a business that has consistently generated strong cash flow through multiple economic cycles. Those advantages don't disappear after one or two difficult quarters. The key question isn't whether Pepsi faces challenges today. It's whether those challenges are temporary, or whether they truly change the long-term earnings power of the business. And that's exactly where investors may reach very different conclusions. Pepsi's latest earnings report didn't change what this company is. It simply reminded investors that even the highest quality businesses are not immune to economic cycles and changing consumer behavior. The recent sell-off reflects growing concerns about slowing growth, but it doesn't automatically define Pepsi's long-term future. As investors, our job isn't to react to headlines, it's to understand whether today's challenges are temporary or structural, and whether the market has priced them appropriately. Ultimately, the question isn't whether Pepsi beat earnings this quarter. The real question is whether the company can continue adapting, innovating, and compounding value over the next decade. Because in the end, great investing isn't about predicting the next quarter. It's about understanding the quality of a business before the market fully recognizes it. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.